let's talk about Forex correlations. Hello traders, I'm Kathy Lee with BK Traders. Welcome back to our channel where we teach people how to trade with fundamentals, how to follow the big stories in the markets, give tips on market structure, strategies, and news on the prop trading sector. In today's video, we're diving into a very important concept. This is oftentimes overlooked and misunderstood, but yet it's one of the most important aspects of Forex trading, and that's Forex correlation. Every single Forex trader needs to understand Forex correlations because it can make or break your trading strategy. If you're new here, make sure to hit that subscribe button and turn on the notifications if you want to learn how to stay ahead in the Forex game, and I'm sure all of you do. First off, what exactly is Forex correlation? In simple terms, it's a measure of how pairs of currencies move in relation to one another. Correlations are usually expressed as values between -1 and +1. A positive correlation of +1 means that these two currency pairs will move in the same direction 100% of the time, while a negative correlation of -1, for example, means they will move in the opposite direction 100% of the time. A correlation of 0 means there's no correlation at all. Now, you may wonder, why does this matter? As a trader, if you're holding positions in pairs that are highly correlated, it is absolutely important to understand that you're essentially making the same bet multiple times, which means that this can unexpectedly increase your risk exposure. For example, if you're trading both the euro dollar and the pound dollar, and you have positions in both at the same time without realizing that they typically move together in a very strong correlation. A single piece of major US dollar positive news or data, for example, could impact both positions in the same way, which would magnify your potential profits or your loss. And the loss part of the equation is really what everyone should be worried about. Let's take a closer look at this. There's a website called metef.net. It's a very good site providing real-time Forex correlation data completely free, and I've included the link to the website in the description below. Now, their numbers are on a scale of -100 to +100, with -100 meaning that the two currency pairs move in opposite direction 100% of the time. A +100, +100, means that the two currency pairs move in the same direction 100% of the time. You can see that on a daily basis, on this day-to-day basis in this image here. Now, if you take a closer look, euro dollar and Aussie dollar have an 81% positive correlation with a green background, which means that's positive. So in your mind, you may be thinking that you're diversifying because you're spreading your exposure between euro dollar and Aussie dollar, two different currency pairs. But in reality, you're basically doubling down on the same market sentiment, the same thing that's driving these currencies higher or lower. This is even more serious if you're long euro dollar and pound dollar at the same time, because as you can see here, they have a 96% positive correlation. Now, this may look different on a shorter time frame, which is important for shorter term traders, because if you take a look at this 15-minute chart, which shows only a 69% correlation between the euro dollar and pound dollar. This is what metef.net looks like. And if you take a closer look, this is what I'm talking about, 96% positive correlation between pound dollar and euro dollar, and an 81% correlation between Aussie dollar and euro dollar. What you can also see is, for example, Euro, Aussie, and Euro CAD tend to not be that correlated. There's only a 23% positive correlation. And Euro, Aussie, and Aussie dollar have a -34% correlation. Now, generally speaking, anything 80% or higher is what is significant. And what's true on the daily chart could also be different on the 4-hour chart, hourly chart, 15-minute chart, and 5-minute chart. And this is a reflection of what's affecting these currencies that day. And it could be Eurocentric or sterling-centric news that have made these currencies move in different directions at different points in time. But you still need to know that even if there are divergences, the relationship, the longer-term relationship that you can see in the daily chart, always converges, which means that eventually they move in the same direction again. And usually that happens quite quickly. So you don't want to necessarily fade the correlation. To manage this, seasoned traders might have smaller positions for each, choose only one position or trade a currency cross that doesn't involve the US dollar. For example, you can see that euro dollar and pound dollar has a 3% or basically zero correlation. Understanding these correlations will really allow you to have a better understanding of the risk in your own portfolio, the risk that you have in the market at any point in time, and how bad things can get if the market doesn't go your way. But it's about more than avoiding risk. It's also about capitalizing on it. For example, if you know that two currencies are negatively correlated, you might go long one and short the other, profiting from their inverse movements. Or you can use currency correlations to identify the root causes of certain movements in the majors or in the crosses, which will enhance your understanding of what's moving in the market and your accuracy of your trades. Being aware of currency correlations isn't just wise, it's essential. You can use Mativ to help you understand how these currencies move in relation to one another, but at some point, it should become second nature to you as you become more comfortable with these correlations. To really leverage the knowledge, you have to consider what's going on, the economic factors, the fundamental factors that are driving these correlations. And this includes changes in interest rates, economic data releases, geopolitical events. These can all influence the correlations in the Forex market. Advanced traders watch these indicators to predict changes in correlations, adapting their strategies before market shifts occur because they understand that Forex correlations and fundamentals matter. If you want to learn more about Forex fundamentals, you can check out my course in the description below. Now, aside from Mativ, you can also plot two instruments against each other on your charts. Now, I use TradingView charts. I think they make it very easy for you to plot two instruments against each other. And in this chart, you can see that I have euro dollar and pound dollar on the daily chart. Now, one is a line chart, the other is a candlestick chart. And you can see very clearly that they pretty much move in lockstep with each other, which means that they move in the same direction at the same time most of the time. So what does that tell you? It tells you that being long both means you're basically doubling up on the same position. And this is an absolutely important concept to understand if you want to learn how to manage your risk, your losses, and your overall exposure in the market. So I hope you learned something from this, and if you did, make sure you like, share, and comment below with any questions or insights you may have about Forex correlations or any other topics that you want me to cover in the future. You can also get my zip indicator and trade strategies for a discount or even free. All the details are in the description below, and I will see you all next time.